Okay, so here's the paradox of the day. Carnival just rolled out a master plan to send $14 billion back to shareholders by 2029, while simultaneously sitting on a $500 million fuel cost landmine. Welcome to Earnings Unscripted. It is March 27th, 2026, and we're unpacking the Q1 2026 results for Carnival, ticker CCL. It's a really fascinating quarter to pick apart.
Yeah, it really is. I mean, on one hand, people are ignoring global uncertainty and locking in luxury cruise vacations 3 years in advance. But when you look closely at the math, the numbers they're heavily massaged by some structural tweaks. And just a quick reminder up front, we're just two people talking markets, so this is definitely not financial advice. But yeah, looking at Carnival, they are running the engines at absolute redline.
Right, and the top-line numbers look fantastic at first glance. They brought in a Q1 record revenue of $6.16 billion, which is up 6% year over year. Operating income hit $607 million, and they swung to a net income of $258 million from a pretty steep loss last year. EPS came in at 20 cents adjusted, which beat expectations. So it seems like they're just printing money.
Superficially, yes, that's exactly the narrative they want out there. But you can really see the skepticism in how the stock reacted today. The stock actually had a great fiscal quarter, up over 23% coming into this report. But the moment the opening bell rang this morning, shares spiked to about $25.20 and then immediately fell off a cliff down to $24.42 before the earnings call even started. The tape just drifted down all session to close lower. The market is looking right past that headline revenue and zeroing in on the costs because they have to absorb a massive, and I mean massive, fuel headwind this year.
The market always finds the catch, doesn't it? But I'm still kind of stuck on the sheer demand side. Customer deposits hit a Q1 record of almost $8 billion in cash just sitting there. And the CEO was talking about how people are buying inclusive packages and excursions way earlier. I guess they even sponsored a week on Wheel of Fortune, and it literally drove record January bookings, like traditional PR actually working.
Right. You can never underestimate the power of game show demographics. But look, that aggressive pricing power is basically the only thing keeping them afloat against these macro shocks. Gross margin yields are up nearly 10%. They absolutely need every cent of that onboard spend to offset rising fuel and foreign exchange drag. And honestly, the only reason the bottom line looks this pretty today is because of a very quiet depreciation policy change they buried in December.
Wait, a quiet policy change? That sounds like the exact kind of thing management hopes people skip over. All right, let's get into the details on that.
Yeah, so this is a textbook accounting lever. Back in December, they just went ahead and changed the estimated useful life of their ships from 30 years to 35 years.
Which sounds like a tiny footnote. But wait, that just means they spread the cost of the ships over an extra 5 years, right? So the quarterly expense automatically shrinks.
Exactly. It completely suppresses the depreciation load going forward. I mean, their D&A expense this quarter was roughly $700 million, which is huge, but it would have been noticeably worse without that tweak. It essentially buys you an earnings beat on paper because the actual cash flow doesn't change, right? The cash is already out the door, but the net income suddenly looks much healthier.
It is so funny how that works. But, to be fair to management, Josh Weinstein did say on the call that an 18-year-old ship can look and feel like a 1-year-old ship. They have this ADA evolution program where they basically gut older vessels. And apparently the passenger yields and the net promoter scores are just as high as the brand new boats. So maybe they really do last longer now.
Sure. Physically, they might. I'm not doubting the renovations, but financially, the timing is it's incredibly convenient because they desperately need that margin buffer right now. Mm-hmm. They are staring down a massive $500 million headwind from geopolitical fuel spikes this year. And here's the crazy part. They refuse to hedge their fuel exposure.
Wait, back up. Zero hedging for a global cruise line? So if Brent crude spikes tomorrow because of a headline somewhere, They just eat the cost entirely? That seems a little reckless.
I think it's pretty polarizing. Yeah, they are just relying on basically using less. Weinstein literally said on the call, quote, using less is the only solution to the price of fuel. So they are trying to absorb it by sweating the absolute smallest details. He claimed they're saving $250 million by micromanaging onboard HVAC loads and even timing ship arrivals down to the final second just to kill the engines faster.
Wow. Okay, so literally turning down the thermostat and coasting into port to save $250 million? That is kind of amazing, but also terrifying if oil just keeps climbing.
Right. And they built their guidance assuming crude stays around $90 a barrel through May. If oil goes higher than that, every 10% swing is about a $160 million hit to their bottom line. They just announced this whole PROPEL strategy to return $14 billion to shareholders by 2029. But if the fuel math breaks, that entire model starts vibrating.
Yeah, which brings us right back to the pricing power, because the only other lever they have is the consumer. And they are absolutely leaning on them. Weinstein had this one line. He said, if they were willing to pay $10 more because of fuel, they should just be willing to pay $10 more.
Yeah, that was blunt.
It really was. No sugarcoating at all. It is just a pure bet that the luxury cruise experience is somehow walled off from inflation fatigue. He even called out AI travel aggregators, basically saying you cannot commoditize a cruise search because they sell a complex experience, not just a commodity seat.
Which is true up until the credit card gets declined. It is a bold game they are playing. I mean, look at what else they are doing. They are moving the corporate legal domicile to Bermuda to save on overhead and dumping their dual-listed structure. They're killing off their old Australian brand. They are pushing out the useful life of the fleet. They are stripping down the machinery to maximize cash everywhere they can.
So they are optimizing the engine as much as humanly possible, hoping the fuel bill doesn't blow up the laboratory. So where does that actually leave them heading into the summer season?
Well, it leaves them projecting a slightly weird Q2. I mean, they are guiding for net yields to be up about 2% and adjusted EBITDA around $1.48 billion.
Wait, 2%? Didn't we just say Q1 yields were up almost 3%? Why are they stepping backward right before peak summer season?
Exactly. Management chalked it up to calendar variations and dry dock schedules. But if you read between the lines, they are clearly dealing with geopolitical softness in places like the Mediterranean. Weinstein actually addressed it. He had this quote where he said, "The world is pretty reactive right now, and people see what is going on, and then life normalizes."
Okay, so their growth strategy essentially banks on consumers just getting completely numb to global chaos?
Yeah, headline fatigue. And to be fair to them, historically it works. People still want the vacation. But looking out toward 2026 and those big Propel targets, they need over 16% returns. That requires a near-perfect macro environment, and there are some very strange wildcards hiding in the background.
Wildcards like the Bermuda legal move we mentioned, or something else?
Something else. The U.S. Supreme Court just accepted a case from Havana Docks Corporation. It is this old lawsuit alleging Carnival trafficked in confiscated Cuban property. If the court rules against them, a $100 million judgment plus treble damages could just wake up out of nowhere.
Whoa. Okay, an international Supreme Court property dispute was definitely not on my cruise ship bingo card today.
Right. They are optimizing the thermostat, but the legal foundation might have a leak.
That perfectly sums them up right now. A beautifully optimized financial machine just slowly navigating a minefield. Thanks for mapping it out with me, Miro.
Anytime.
And thank you all for hanging out with us. We will catch you after the next earnings call. And if you enjoy letting us do the heavy lifting on these earnings drops, go ahead and follow the show so new episodes just appear in your feed. Just a transparent heads up that this is an AI-assisted podcast, which is how we managed to crunch those massive financial filings into a short conversation so quickly. We would really love your feedback or ticker requests, so shoot us an email at earningsunscripted@datamadness.ca or find the X link in the show notes.
Get you next time.